No one on the internet is saying this, so I'm going to. One win or one winning streak is not proof that you've made it, but you keep increasing risk regardless, and you know how that worked out. So in order to fix that, here's what we're going to do if I were your mentors. But we have to understand why this happens in the first place. All right, so when a trader wins, the outcome that you have, that winning streak, that win, updates your internal expectation of the market. And so the mind treats this recent familiar success as evidence of improved accuracy, timing, or skill. And this update happens quickly, and you don't even realize that it's occurring. Like, it's without conscious evaluation. And so perceived risk of the market, of your trading, actually decreases, even though actual market uncertainty or conditions have not changed. And so this lower perceived risk, this fact that because you won, you can do better, it alters how you size your positions. And this increase of risk feels justified because now you, the trader, believes the likelihood of loss has temporarily decreased. Now, this belief is not based on statistical validation. It is based solely on the emotional weighting of recent outcomes. And as a result, risk expands faster than the strategy's ability to absorb this variance of the market. And once this risk increases, this system is going to become fragile because losses that would normally be tolerated now carry outsized impact due to the increased risk, the increased sizing. And so a small losing sequence after the fact produces disproportionate damage to your equity. And the trader then is exposed to accelerated drawdown without having adjusted the behavior to match this new risk level. And this creates a really nasty feedback loop. And so after the first large loss, the trader attempts to recover previous gains by maintaining or increasing the risk again. And the internal model that you've developed still expects success because of the familiar wins beforehand, because recent wins remain salient. Therefore, the trader doubles down rather than contracts your exposure. And so each loss compounds both financial damage and this internal urgency to make that money back. Your decision quality will degrade because now you're reacting to your account fluctuations rather than just simply executing the strategy. And these rules weaken further. The rules of your strategy, the guidelines of your strategy, they weaken further as the trader attempts to regain control of their account. And now, because of that, the account deteriorates rapidly because risk has expanded while discipline has been thrown out the window. And the underlying cause is outcome-based risk calibration. The trader has been taught how to generate profit, but not how to preserve the capital of their profit. Wins are treated as permission to increase risk, take more trades, yada yada, rather than as just simple neutral samples within a larger sequence of trading. And without training that anchors risk to long-term expectancy of the market model, risk becomes tied to your emotional state. You feel good, you risk more. You feel crappy, you risk less. Now, as a mentor, my goal, my rule, my role is to decouple risk from recent outcomes through repeated exposure to the same risk parameters across wins and losses. The trader, you, the student, learns that the edge expresses itself only when risk remains stable. And the account survives because variance is allowed to unfold without being amplified by this risk adjustment. All right. But until you learn how to do that, increasing risk after small wins will continue to destroy your account. And that behavior is not reckless by intent. It is the predictable result of a learning system that confuses short-term success with reduced uncertainty.